Hi there, how you going? Darryl Wilson here from Affluence. Going to do something a little bit different this month. I just wanted to give you a bit of an update on what we're seeing in markets. We think we're at a bit of a tipping point in terms of the economy, and we wanted to explain our thinking, what we're doing about it, how we're positioned, and give you a sense of how we see the rest of the year playing out. We think that's quite important at the moment to understand that thinking, because it's probably a little bit different to the general market, and so we'd like to explain that a little bit. And I think that's going to lead, in our mind, to some very, very interesting opportunities as the year goes on. I'm going to talk a little bit about that, and a little bit about each of our funds, and where we're getting excited in terms of our portfolios. If you want to know more, we're going to make a full copy of this presentation available on our website in the email if you get it via email, and obviously there's plenty of other information on our website as well. I'm going to assume that you have a basic understanding of who we are and what we do, so I'm not going to spend a lot of time on that, but just very, very quickly, our reason for being at Affluence is three things. We want to deliver you investments that can give you better than average returns over 3 years and longer, regular income, either monthly or quarterly, targeting at least 5% per annum, and hopefully less ups and downs than the markets in general along the way. We co-invest alongside our investors in each of our funds, and we charge only a performance fee, meaning that we're aligned with you, our investors. This is the performance of each of our funds compared to perhaps an index or a passive alternative. We focus on the 3-year and longer period, as I mentioned earlier. So our Affluence Investment Fund, we've compared that performance to passive alternatives, for example, being the Vanguard Growth and Balanced ETFs. And as you can see, we have delivered better than average returns over 3 years and longer. The LIC fund is probably more akin to an equities fund. We've compared that to the ASX 200 index, which is its benchmark. And again, we've managed to deliver pretty consistent outperformance there over the medium and long term. And finally, the Small Company Fund is our wholesale investor-only fund currently. Compared to the Small Ords, we've done very, very well there as well. So I think the main message in regards to our positioning is that there's two limbs to what we're doing at the moment. Firstly, we've obviously had a correction through 2021 and a bit of a bounce over the last 6 to 9 months. We don't think it's over. So we are carrying more cash than we normally would in all of our fund portfolios. And we're doing that because we believe it's going to get a bit worse over the course of this calendar year and perhaps into next year, and then it's currently going to get better. And we're holding cash in order to continue to buy attractive opportunities as that kind of plays out. Having said that, we are already seeing across a range of sectors, a range of areas, some pretty exciting stuff, and we have been buying. We have been selectively and slowly adding to all of our fund portfolios over the course of the last 9 to 12 months, buying what we believe to be, as I said, the most exciting opportunities, and at some pretty impressive discounts. This is a chart from L1. I'm going to just talk through 6 or 8 charts to give you a bit of a picture of why we believe what we believe. Firstly, this shows the kind of divergence in valuations at the moment. So investors are still paying up big time for offshore earners, defensives, perceived low risk stocks. They're all trading pretty close to their historical highs over the last many, many years, 20 years or so. Whereas some of the areas we've been adding, including resources and value stocks, the so-called value stocks, the low PE stocks, we're seeing exceptional value compared to history. So we have been selectively adding in those areas, among others. This is a global fund manager survey run every month by Bank of America. They ask a bunch of questions. This question was, what's the most likely outcome? You can see here that it's probably 2 to 1 at least. I think it's going to be a soft landing versus a hard landing. We think it's probably at least around the other way. We think now there's probably a 70 to 80% chance of a hard landing, not only in Australia, but globally. Now, that doesn't mean markets are going to fall massively, but it does mean perhaps a slow grind and many more opportunities to add to the portfolio over the next 12 months or so. One of the big reasons we believe it's not over yet is because if you look at a number of what are called leading indicators, which try to give a picture of where the economy might be heading in the next 3 to 12 months, they all look pretty ugly. And so this is just one example where we can see the manufacturing index and credit downgrades. And what that tells us is that a lot of those indicators that are pointing to where the economy might be going over the short term are getting worse. And that also plays out with what we're seeing out there, anecdotal evidence and the stuff coming down the pipeline that we know is happening. What we're seeing in America and in other places, there's a bit of a divergence between what investors are saying and what they're doing. So this is an example of consumer sentiment. You can see that consumer sentiment in the States and in fact here in Australia has dived. Consumers are very bearish, and yet they're maintaining their equities allocations at pretty close to the sort of highs over the last 20 or 30 years. So they're saying one thing, they're doing another. That's one reason we believe it's not over, because when the sort of earnings downgrades come that go with this consumer sentiment, we're going to see some decent corrections in markets, and that's going to spook investors a little bit. One of the main problems we've got, and everyone's been talking about inflation for what feels like forever now, it's probably still going to be a front page story for the next 18 months to 2 years, we suspect. And what's going on at the moment is headline inflation's coming down quite quickly, but behind that, we're seeing this very, very sticky services inflation, and that's really being driven by wages. And if you think about that, what's happening here in Australia, for example, now is employees are going through their second annual wage increase since inflation sort of started to get out of control. You were seeing average wage increases now coming through of anywhere between 3.5% to 5 or 6%. And that, very rare that anyone's getting a wage increase of less than sort of 3.5%, 4%. Now, what that does is it pretty much ensures that the cost of services will remain high over the next 12 months or so, because wages is one of the big inputs into services costs. And so whilst the core or the headline inflation is coming down, the whole sort of the stuff that's sitting in behind that's going to remain a lot stickier. And what that's going to mean is it's going to get very, very difficult for inflation to come back down to that 2 to 3% band that our Reserve Bank targets, and the similar levels that other global central banks are targeting. And we think pretty much inflation is baked in to stay between probably 3 and 5% for all of next year and into 2025. And that means that interest rates are going to stay high. They're not going to come down. A lot of markets are pricing in interest rates to fall later this year. We just don't think that's possible, given what we feel is going to happen with inflation. The only way it is possible is if we have a decent recession and we see quite a lot of job losses, which will help to reset everything. But that's probably a case of be careful what you wish for. So at the very least, we think we're going to see sticky inflation, interest rates remaining high, and that is going to continue to be a drag on the economy. In the US, they've got a few more problems than here. One of the problems they've got is their regional banks. It was talked about earlier this year. Everyone thinks the problem's gone away, but it has led to a credit squeeze building up in the States. What's happened is a lot of people have taken money out of these regional banks and put it into money markets. The banks have got less to lend. That's being kind of exacerbated by the fact that there's a real issue around commercial property now in the US, with valuations adjusting quite heavily. All borrowers are now looking at higher base interest rates, higher margins because banks are charging a premium to lend, given the greater uncertainty out there, and a generally more difficult business environment. All of that means less credit available and less growth. Here in Australia, migration is actually acting as a decent shock absorber in the short term. So we've seen a lot of arrivals into the country since probably mid last year. We will continue to see that. we think, for the next 12 to 18 months. At least that's what the experts are telling us. That helps to alleviate the employment shortage, and it helps to keep wage increases under control, and it helps to keep our economy growing. But there is a downside to that. We do have an issue around housing, and obviously migration is one of the things that's driving demand for housing. Unfortunately, we're in the position where new homes are not being built, and there's a couple of reasons for that. Firstly, costs are going up and up and up. And secondly, obviously, we've had a lot of issues with builders, which means we're seeing much more cautious new home buyers wondering if their builder's going to make it through to finish their house, and obviously much more cautious banks who are looking for fixed price contracts and wavering a little bit on providing finance for new homes. So all of that means we've got the situation, unfortunately, where we generally don't have enough housing at the moment. We've got migration driving demand, and we're not building as many as we need. And that's probably the first time in the last 25 years we genuinely, I think, have had a housing shortage. And that's led in the short term to an increase in house prices again. But the key thing we think that's going to drive the trend for the rest of this year is the great mortgage reset. And so, this is something that's been talked about a lot. What's not well understood is that we're really only now just the beginning of the mortgage reset. So what's happened is we've had, up until about a month ago, the highest proportion probably ever of fixed rate mortgages in Australia, because of the extremely low rates that were available in 2020, 2021. We're now seeing those start to reset at much, much higher rates. The first wave has started. It will continue all through this calendar year. And what we expect to happen is that each month you will see a new little mini wave of borrowers who are having to reset from much lower rates to much higher rates. Going with that, you obviously got continued pain for those who have already reset. So unfortunately, consumers don't adjust their habits until they have to. We're just starting to see that happening now. We have seen in the last couple of months a bunch of retailers make announcements around revenues saying, look, we had a sale or whatever, revenues have just stopped. We've seen a big, big change. And so that's one of the issues that's driving the economy for the rest of this year. So we think we're going to see this gradual increase in pain, unfortunately, as the year goes on. And in terms of how that impacts listed companies, we're obviously going to see some damage to revenues and profits as we go through the rest of this year. And that's one of the key reasons why we believe we're going to see better buying across the board. That has pretty wide-ranging effects, not only on the obvious areas in the stock market, but probably through pretty much the entire economy as the year rolls on. And as I said, that is ultimately going to lead to much lower consumer spending numbers, which will in turn impact the economy. So look, that's probably a picture of how we're seeing it. We're not super bearish. All we're saying is, it pays to be patient. We're going to see more opportunities as the year rolls on, and we're ready for them, basically. So a quick look now at each of the fund portfolios. We're going to do the Affluence Investment Fund first. And just as a reminder, what you're getting with the Affluence Investment Fund is really the broadest selection of diversified investments we can find. So across a bunch of asset classes, a bunch of different sectors, we go out there and find what we think are some of the best funds and the best fund managers available in Australia across all asset classes. We supplement that with a couple of our own strategies and around our circle of competence. That includes an allocation to listed investment companies. It includes an allocation to what we term discount asset plays, things like REITs and other opportunities trading below their asset value. And we put that all available in one single fund. At the moment, like always, it's very diverse. I'll give you a flavor of what it looks like. So this shows you our kind of high-level asset allocation before any hedging's applied. So this is as at 30 April. It hasn't changed markedly to 31 May. Around 10% cash, 15% in the Affluence LIC Fund, which gives you access to a range of 25 to 30 underlying listed investment companies, about 25% in Aussie equities, 11% global, 9% in property, 5% resources, 15% market neutral and alternatives, and around 6% in debt and fixed interest. Now, that's not the whole story. This is really categorized by the underlying investments core kind of holdings. And just to give an example of how that might look, so the Affluence Investment Fund, for example, if we look under the hood for that 15.3%, we can see that roughly 30% of that's currently being held in cash. Around 40% is Aussie equities, 30% is global allocation. So within each of these buckets, it's not necessarily as attached to the market as you might think. We're also running a reasonable amount of hedging across the portfolio at the moment to help protect against any downside risk in markets as well. The slide graph here gives you an idea within each asset range, how we're looking. So the grey bar shows you the range we might typically be at within our Affluence Investment Fund portfolio. So if we use cash as an example, we would typically be between 5% and 20%. Our kind of neutral would be about 7.5%. We're currently about 10%. And if we look across the board, our kind of debt and fixed interest allocation is slightly below average, but that is definitely trending upwards. There's a huge opportunity in this space at the moment, and so we would expect to see that grow quite a bit over the next few months. Alternatives, given their potential for downside protection, is running very high on our historical range. Resources, very cheap at the moment, but may get cheaper, and so whilst we're slightly overweight, we're still quite cautious. Property, very much underweight and very much skewed towards largely discounted REIT holdings. Global equities, we're below average. Aussie equities below average, and LIC fund is about average. Just a look at a couple of those sectors to give you an idea what's underneath that. So this is our alternatives portfolio. It is dominated by 4 what we call all-weather performers: Arnott, Bronte, Totus, and Attunga. Each of those underlying funds have done very well in aggregate, but have also done very well in market corrections, and that's why they're in the portfolio. That part of the portfolio really acts as a bit of a shock absorber to help weather the storms that come our way. Within our global equities bucket at the moment, we've got a very, very strong focus on value investing. So here's an example of 4 of the funds that are in our global equities bucket at the moment. Pzena is an emerging market fund focusing on large companies in that emerging market with low PEs and very strong balance sheets. Schroder Recovery, European, UK focused fund, again, solid balance sheets with kind of underappreciated value. Packer & Co, very diverse, very conservatively positioned at the moment, and Phoenix is a mid to small cap kind of discount capture strategy. Phoenix run a global strategy and also an Australian strategy. If we look at our Australian allocation, there's quite a hefty allocation to small cap value. It's probably one of the areas we're most excited about at the moment. We are seeing extraordinary opportunities in the small cap space. Again, we've got Phoenix's Australian fund in there. We've got EGP Capital, which holds a kind of an eclectic mix of heavily discounted stocks. Glenmore is a mix of growth and value, very small fund with an exceptionally good long-term track record. And Samuel Terry, probably one of the best fund managers available in Australia at the moment. Well, actually not available because that fund's currently closed to new investors, as are many of these funds, but exceptionally short, medium and long-term track record for Samuel Terry. Amongst resources, we've got about a 5% direct exposure, but if you look through to the underlying investments and look to what they're holding, it's probably around 10%. So, for example, within our LIC allocation, there's 3 or 4 resource-focused LICs within there that kind of increase the overall exposure to the portfolio. Having said that, that's quite delicately balanced between gold miners, which are a fairly hefty part of the allocation, and other resources names. So, what that helps us do is, if we do see a further correction, it's going to help that resources bucket be a bit more resilient than it otherwise might be, because we've got that gold allocation within there. So Baker Steel is a specialist resource fund that invests just in gold miners. Terra Capital focuses on small to mid-cap developers and producers in predominantly Australian and Canadian markets. And those sorts of companies are prime targets for the larger resources companies who are looking to grow their resources without having to bring on stream their own mines. Ausbil is a long-short strategy, and there's other allocations through various other funds and holdings that we have. Within the property space, I think this would be described as a very eclectic mix at the moment. About 9% of the portfolio is in property. About 6 or 7% of that is in REITs. We've got a few smaller REITs in the retail space. So through a couple of Aussie holdings and through Unibail Rodamco, which is a global REIT manager. They all have some things in common. They've got good solid income that we think is going to be reasonably resilient over the next 2 or 3 years. They have a decent runway on their debt facilities, and they're reasonably geared. That's a manageable debt facility. So we're picking those REITs where we don't believe they're going to have to go through any major debt resets in the next 2 to 3 years. The income is fairly secure, but nonetheless, they are trading at 30, 40, in some cases 50% discounts to net asset value. A couple of the other things in our REIT bucket at the moment, in our property bucket, US Masters Residential is currently going through a bit of corporate action, and it's effectively a portfolio of New York apartments and houses, trading at around a 50% discount to the appraised value. With a plan most likely to sell the bulk of that portfolio over the next 2 or 3 years. Kyland is a conversion from a forestry estate on Kangaroo Island in South Australia to what will be a pretty impressive agricultural operation, with the potential for a whole range of carbon credits to be generated as well as part of that process. So very, very interesting one, that one. Amongst the debt side of things, we've got some listed investment trusts, which are essentially debt funds trading at a discount. We've got even more of those in the LIC fund at the moment. But what we're also doing is adding to our existing debt managers. We can get currently 7 to 9% with what we would consider to be pretty low risk in a whole range of managers. So there's a couple of the managers there now. Merrick's Capital's been in our portfolio for quite a long time. Fort Lake was a recent addition. We've made another addition this month, and we'll probably add 2 or 3 more in the next 2 or 3 months. So I think you'll hear a lot more from us around that fixed interest space as the year goes on. We think that's going to be a very interesting place to be for the next 2 or 3 years if interest rates stay where they are. So that's a bit of a look at the investment fund portfolio and some of the kind of key areas that we like. Looking now quickly at the LIC fund portfolio, just give you a big flavor of that. Firstly, I would say this strategy, I think we've proven now that this strategy is a very, very good one. This is FE data. This is showing all of the multi-asset funds in Australia, all 514 of them. And you can see the LIC funds coming first quite comfortably over 3 and 5 years out of those 500 or so funds. And I think we've genuinely found a way here with this LIC strategy to be able to generate additional upside through the discount capture strategy that we use there. So not only are we getting the returns that the managers generate from the underlying listed investment companies, but we're also getting potentially some value add out of that discount capture by buying LICs, when those discounts are larger than they should be, and holding them when they normalize, and then perhaps moving them on at that point. We're excited about this strategy. We've got capacity for probably another 30 million before we close this fund to new investors. If you haven't already, I would recommend you have a good look at it. If you're in our Affluence Investment Fund, you're already getting about a 15% allocation, as I've said, so bear that in mind. But I think this fund, if what we think is going to play out this year does play out, we'll see even more opportunities in LICs than we're currently seeing. We tend to have 20 to 35 LICs in the portfolio at any given time. In a perfect world, each of those LICs has a very good manager, is trading at a big discount, and has some sort of catalyst to close that discount. We don't obviously often get all three of those within the same LIC. We're looking for at least one or hopefully two of those to be the case to get an LIC into our portfolio. And that's essentially what we're looking for to construct that portfolio. This is the discounts since inception. So on average for our portfolio, at the moment, it's about 18 to 19%. So in other words, if the value of the investments that our LICs had was $1 on average, they're trading on the stock exchange at 81, 82 cents. And so we're buying them about 18 to 19% discount to the value of their underlying assets. That's obviously higher than normal. The only time since we've been doing this fund since 2016, the only time it's been higher has been in 2020 during the COVID crunch. So if, again, we may see an opportunity for that discount to get above 20% again later this year, and certainly that COVID period represented some exceptional buying in the space. We think we're going to get that opportunity again. We're ready for it. We're currently carrying around 30% cash in the fund, and the rest is split amongst the portfolio. We're still happy to own even at these prices for sure. This gives you some idea of the diversification. So by geography, you've got, even though these are all listed on the stock exchange, you've got around 30% in globally focused LICs and about 40% in Australian focused LICs. If you look at it by market cap, we've got, a range of market caps from the very small 0 to 50 million right up to a billion and above. Varying discounts, the right discount's different for every LIC. So some we might be happy to own at par, others we wouldn't buy at a 30% discount. And it's very much dependent on the strategy, the manager, and a bunch of features around each individual LIC, which we track pretty closely. And finally, a range of strategies. So you're seeing, almost half of the portfolio is in long only type strategies, but we've got some absolute return diversified and some alternative strategies in there as well. So these are not just solely equity focused. There's a range of underlying things going on. If I break our portfolio into three kind of larger areas, just to give you a flavor as to how each area looks. At the moment, 15, 16% is in the debt LIT. So these are really own loans or credit or bonds in various different markets. At the moment, about a 7% to 8% average yield we're getting from these LITs, and around an 11% discount to the underlying value. If those discounts normalize, obviously we'll get to add a bit more value. So they're certainly something we're reasonably excited about. The discounts have been bigger, but the yields now have moved up a lot in the last 12 months. So we're getting paid very, very handsomely to wait currently for those discounts to compress. Amongst the Aussie equity focused LICs, around 27, 28% of the portfolio, 13 holdings, average discount 19%. There is a bit of a focus on resources and a bit of a focus on small cap value within that. And there's some LICs where we see exceptional value appearing, because not only are we seeing reasonably large discounts, but in some of the small cap and resources portfolios, we're also seeing those portfolios at very, very attractive prices as well. So what I mean by that is, not only is the discount come down, but the actual net asset value has already come down quite a bit as well. So we're buying, if you like, a discount on a discount. And finally, amongst the global LICs, the global exposures, 11 holdings, over 20% discount to NTA on average. that is normal that the global LICs trade at a bit of a higher discount than the domestic ones. But again, 21% discounts, pretty decent discount. Again, we're seeing a range of allocations. There's equities obviously in a range of different markets, but also private equity resources, and a few other kind of eclectic strategies in there as well. So some of those LICs have, we've just gone through one which went through a delisting, and so we were able to hold that as it went from a sort of a 10 or 11% discount, and it went through that delisting process. That discount closed up, and effectively we redeemed that LIC about a week ago at NAV. So again, we were able to add some value through effectively capturing pretty much all of that discount. So that's the LIC portfolio. We are excited by what we already have in the portfolio, but we're obviously as cashed up as we've ever been. I can't think of a time when we've had 30% cash before, ready for opportunities to come up. Small Company Fund, very quickly, currently available to wholesale investors only. Small caps, by definition, can be a bit more volatile than most other types of investments, so bear that in mind if you have an interest. Having said that, there is exceptional value in small caps at the moment. The small caps index has fallen by 15 to 20% more than the ASX 200 over the last 18 months. And it was already cheaper than average coming into that period. So certainly the areas where we are focusing. Within our small caps fund, again, it's a bit different. So you're getting a combination of three things. You're getting a combination of probably around 50 to 60% of the portfolio is a range of small cap managers that we invest with. So you're getting diversification through access to a bunch of different managers doing different things in the small cap space. You're getting some listed investment companies focused on small caps at pretty decent discounts. And you're getting a few direct holdings in areas where we have a bit of an edge, which includes things like REITs that I've previously mentioned as well. So this is one example of the portfolio and sort of some of the investments within it. At the end of April, we were carrying about 20% cash in this portfolio, 14% in a few LICs, around 43% in small company funds. So you would expect the bulk of this cash also to get allocated into that area over the next few months, and around 19% in other listed stocks. You can see here some examples of some of the holdings in each of those areas. So if that's of interest to you, get in touch, have a look on our website, and you can learn more about that fund. Okay, so that's really it for today. Some key takeaways. We think it's going to get worse, unfortunately, before it gets better. We're ready for that. We're waiting to buy. We would encourage you to be ready as well. Certainly, as we see those opportunities emerging, we'll be letting everybody know. We'll certainly be looking to grow the funds as those opportunities emerge. And we expect that to happen as the year progresses. There's a lot to be excited about already in the portfolio. We think we'll get even more excited as the year progresses. If you want to know more, there's a heap of information on our website. We have a dedicated page for each fund and also a lot of other information. But you're also welcome at any time to give us a call, drop us a line, get in touch in whatever way works for you. Obviously, the PDS for each fund and the TMD is on the website. If you're interested in investing, you can apply online or print and download the forms. And if you're not already, I would encourage you, if you've got any interest in what we're doing, to subscribe to our monthly newsletter. We'll give you an idea of what we're doing each month. Obviously the fund reports go out, and hopefully a bit of topical information that's of interest as well. So that's it for today. I hope you enjoyed that. Feel free to get in touch at any time if you've got any questions, and thank you very much.